Well, hello everybody. It's Ken Winans and Stephanie Larson, and we thought we'd give you an update video on the volatility in the markets and certainly the volatility in the headlines and all the things going on around the world, and just tell you what we've been doing around here over the last couple of weeks. It didn't take long until after we'd already dried off the New Year's party dishes that we suddenly had volatility in the markets. And I've seen this happen so many times where January suddenly gets very volatile as people waited to take profits off the table until the following year for tax reasons. So it's tragically predictable, as most things in history are. But let's talk about where we're at. And let me just say very quickly, many of you watching this, we have been down this rodeo many times. It is just a fact of investing. Things don't go straight up forever. They do correct. And I think what we like to do is just start off what is holding up well. And, knock on wood, the income side of our strategy, the bonds and some of the preferreds are doing quite well. They're holding up well. There's clearly money going towards this area, and that's why it's holding up. Again, I know many of you have been trying to reconcile pricing on websites versus our reports and all that, but generally speaking, bonds are holding up well. Steph, you want to add anything to that? Or?
Yeah, no, getting paper for their portfolios is still actually quite challenging. That's how tight the prices are. As Ken mentioned, as volatility picks up, people tend to rotate. We personally believe that this isn't going to be just like March 2020, where it's a quick down and quick up. So I think people that are more risk adverse are moving at least a portion of their allocation to the bond side, and it's making the appetite strong still on fixed income. So paper's tight, but I'm finding it, but it's a lot harder than it was even a year ago.
Yeah, and it doesn't mean that, we're always, when people call and say, there's cash in the account. Yes, we're aware of the cash each and every day, but we don't want to rush out and buy things that are overpriced. The other area that's holding up, as you know, we've been talking quite a while about commodities, and we put commodity exchange traded funds in most of your portfolios. The commodities are in fact holding up. The reason for that is because of inflation. They're an inflation play. In fact, I just mentioned Stephanie, I find it very interesting, is just when people were writing off gold and silver as inflation hedges, they've been holding up very, very well as crypto has been blowing up and the stock market's been volatile and all these other things that the old standbys seem to be holding up well. Also, the dollar, quite frankly, is holding up very well through all this. And I think that is just because when you compare the dollar to other currencies around the world, it's the least dirty shirt in the hamper. It's certainly not perfect, but it's better than, I don't think people necessarily want to jump into Russian rubles right now or Chinese yuan. That's just not where people want to go.
Well, I was going to say that, when you head to the end of a bull market, people tend to get greedy. At the end of last year, a lot of our clients wanted more. Like, why aren't you in Bitcoin? Why aren't you taking these aggressive moves? And Ken and I both knew that this was going to end. We've been saying it for a while. Bitcoin now, if you look at it, it's lost half its value. It's not a hedge. It's not a currency. It's not anything. Those very risky, attractive investments that people are doing because they just want that last little squeeze out of the market, it's now biting everybody in the butt. And so, for us, you're right, some of the old staples are holding true, but commodities are a good hedge. But in reality, the market was it was stretched too far. The market does not go up forever. It can't go up forever. It's not supposed to go up forever. So what we had the last several years, but in reality the last 12 years, was an extended bull market. So it's time. It's time for a correction. But what you have noticed, if you pay attention to your portfolios, which I know the majority of you guys do on a pretty much daily or weekly basis, a couple Fridays ago we started raising cash. We enacted our risk mitigation protocols. And what are those? Well, we cut things that are misbehaving or pulling back. We raise cash in all of them. And over the last 2 weeks, we put in multiple hedges into everybody's portfolios. We still have more that we're going to cut and raise, and we are going to defend the portfolios the best we can, because what have we done in the last several years? Made 10, 15, 20% across the board in all of our portfolios. And when you're up 40, 50, 60% for several years, a 10% correction hurts, but we're gonna defend them the best that we can and make sure we don't give back everything that we worked so hard for the last several years.
And on that being said, I mean, what we try to do, and also it's important to remember, I've studied every bear market in the last 150 years. None of them go straight down, and that also includes the Great Depression. It did not go straight down. There were rallies. There are very powerful bear market rallies that actually suck people in. With those rallies, and certainly where we find there are interim bottoms or interim oversold positions, we will lift the hedges. We will let the portfolios run back up. At those interim tops in a bear market, we will raise more cash, put hedges back on. This is exactly what I did in 2007 and 8. When we look at 2020, I know a lot of you are using that as your baseline. I would caution you to be careful about that. The Federal Reserve stepped in and saved the world in March 2020. They're not going to do it this time. We're going back to a normalization of interest rates, money supply. The Fed can't do it, in my opinion. It's already stretched too far. So what we're trying to tell you is we're here, we're working, we're doing things. And what has always happened in pretty much every bear market I've ever come out of, managing money for the last 30 years, is that we do look for opportunities at the bottom. We do step in and will commit cash when we believe it is prudent to do so. We already know what targets we want to buy as far as individual stocks, preferred stocks, bonds, commodities, you name it. We know what we want to go after. So believe me, we have a strategy that I think will work through this. Now let me just very quickly talk about inflation. Most of us who are watching this video either didn't live through the last cycle or we don't remember it real well. There's a phrase called stagflation, which means you have inflation with a slowing economy. It's a tricky word. It's a tricky investment situation. You can make money in it, and you have to navigate it, but you have to do it with a discipline. You just can't simply buy and hold and turn your back on your portfolio. That will not work in this environment, folks. You have to navigate it. And then there are times to raise cash. There are times to get rid of things that are not working. A lot of people who had been writing certain stocks thinking they will go up forever, typically they are not the ones that do well in this environment. So just keep in mind that the leadership is going to change of what goes up in this market. The time in which you're in it changes. And the last important point, we are keenly aware about tax issues. You didn't hire us to trade the portfolios, but we're going to let the market determine when and where and why we raise cash. We will do our best to keep an eye on December, just like we did last year. I would have loved to have raised a lot of cash late last December, but I knew the tax bills would be pretty high. And also the placement of investments. In other words, where you have tax deferred accounts and you don't need income, that might be where we stick your bonds, even though you might have 4 or 5 accounts that you have us manage. But listen, we just want to give you a quick video. Unlike our competition, we don't shy from having conversations during tough times, and certainly feel free to give us a call, but as you can imagine, we're very busy during market hours. We'll be happy to talk to you in the afternoons or even in the evenings if you need to. But let me just also give you one last piece of advice. To try to tell us that you want to raise cash and you want to hold cash, and you will tell us when you want to invest. Let me just give you a piece of advice. Every client who's ever tried to arm wrestle us in a bear market usually has missed the rallies or has ended up causing themselves self-inflicted wounds. I'm asking you to trust us. I'm asking you to let us do our jobs. I know it's tempting to listen to Jim Cramer or somebody else out there. They don't manage your portfolios. We do. So please, let us do our jobs. Know we're doing the best we can. We're not perfect, but as I said before, we always come out of a bear market positioned to make money and to make back losses as quickly as possible.
I would also be cautious of headlines. If you looked at the end of last year, I think I mentioned this in the last video, but if you looked at the end of last year, the Nasdaq hit all-time highs again, but 2/3 of the companies in the Nasdaq were below their 200-day moving average. That is insane. So it's the larger companies that had been continuing to drive it up. The overweighted companies, the Apples and the Teslas of the world, are what were pushing the market, the index higher. And it wasn't a real reflection on what the market was actually doing. So, just be careful. Just because you see a scary headline, you have to really kind of get into it and the numbers, and it doesn't necessarily reflect your portfolio. So, we understand that it's scary. That's why we're doing this video. We wanted to reach out, make sure everybody, knew that we were on it. You should see a lot of activity in your portfolio. And we are, like we said, gonna defend it the best that we can.
Yes, that's it.
Okay?
Folks, we'll get back in touch with you probably in a couple of weeks unless there's some other developments. But also do remember, we're still in the middle of earnings season. A lot of companies are posting their numbers. Some of the numbers are actually pretty good.
Yeah.
And those stocks rally on those on the news, and we do and own a lot of what I would call thoroughbred companies. Very well, not necessarily famous companies, but they're well run and they know how to navigate this world. And then the other thing I would bring up is that if you do want to do an allocation change, just take a deep breath and think about it before you do it. We just don't do it because you're scared. Do it because there's a logical reason to make adjustments to cash holdings, balance of stocks and bonds in the portfolio, things like that. And we're certainly more than happy to have those discussions. But anyway, hang in there, everybody. All bear markets do come to an end, so we'll talk to you again soon. Take care.
Bye, guys.